how real estate generates income while reducing taxes. Hello and welcome back. Thank you for joining us for episode 2 of this series. In the last episode, we discussed why the 2026 tax landscape has changed and why long-term planning matters more than ever. Today, we will focus on how real estate can generate income while also reducing tax liability. At first glance, income and taxes seem directly connected. Earn more, pay more. But real estate works differently. One key reason is depreciation. Depreciation allows property owners to deduct the value of a building over time, even though the property itself may be holding value or increasing in price. This creates a situation where cash income is coming in, but taxable income appears lower on paper. Another important factor is cash flow. Cash flow is the money left after expenses are paid. In real estate, it is possible to receive steady cash flow while depreciation and other deductions reduce the tax impact on that income. This is why after-tax returns matter more than headline numbers. After-tax returns answer the real question: how much do you actually keep? Many people focus on gross income or total rent collected. Wealthy investors focus on what remains after expenses and taxes. That difference is what compounds over time. The key takeaway here is simple. Real estate does not just generate income, it changes how income is treated. In the next episode, we will clearly explain bonus depreciation and cost segregation. We will discuss what these tools really do, when they make sense, and when they do not. Thank you for watching, and I will see you in episode 3.